far away from where it should have been relative to where the Federal Reserve balance sheet was currently at. If we move up to the same graph, but only showing, same time period, but only showing the U.S. stock market, here we see between the time of 08 and 09, the market did bottom. So, that's interesting, because the Federal Reserve balance sheet is critical. It is a significant variable to consider, in terms of the U.S. stock market. It would make sense that as the market fell to a certain point and the panicking was so bad, yet the monetary base basically hadn't decreased really that much, that it created a buying opportunity in the stock market. And then we went on a bull market from there on. And here we see that the actual risk model, the Z-score, it stayed below zero for many years. It stayed below zero, from 08 to pretty much 2016. So from 08, it was basically a buying opportunity, you could say. Like, as long as we were below zero, over time, this model typically mean reverts. It gets closer to zero. So what we would typically expect is the market would appreciate, or the Federal Reserve balance sheet could just decrease over time. That would also make this model get closer to zero. But that's generally not what happens. Generally, the stock market appreciates, and we can see from from 08 to 2016, 08 to 2016, for the most part, the Federal Reserve increased its balance sheet pretty substantially. And you can see right here is representing the response of the crisis, the 08 crisis, when they bailed out the economy, all that money printing to buy up those bonds, and the what was it? What did they call it? There's so many terms for it. The financial engineering, the quantitative easing, and Operation Twist. All of their policies that they came up with, just to expand the monetary base. That's what this graph is showing here. That's a highly unusual uptick right there. That's what is that's what's critical here, is that the Fed balance sheet generally does not change significantly over time. In any given year, I would say it generally just kind of stays steady. But in response to significant economic events, they will act, and they will increase or decrease the monetary base in response to support the economy. And that's what these huge percent increases are, these huge upticks where they suddenly, they create a policy where they have to print a whole bunch of money, several $billion a month, buying up bonds and stuff like that. That's what this graph is representing, the buying of all those bonds. To take all that bad debt, that shit debt that was sold on Wall Street, they're buying it and putting it in their trash bin of a fucking account. I'm sorry, their account, holding that bad debt on their balance sheet for the country, basically. You can see I'm really frustrated when I talk about this, because when you see what I see, then I don't know what this really means. It's just, if it stands out to me, then I think it would stand out to anybody else with some kind of background in statistics or economics or banking, but you don't hear them talking about this. So either I'm way off base, I'm way off, and I'm reading into these numbers and reading my thoughts into these numbers, or something else. I don't know. The reason why I'm making this video is because I want somebody who's better educated, more in tune to what's going on in terms of the economy and finance and banking and stuff, and economics, econometrics, to follow up on me, correct me, tell me I'm wrong, tell me what I've done wrong, tell me what I'm missing, what I'm overthinking, misinterpreting, anything. Once you see where I'm going with this. So here we see, up until 2016, we were below the zero, meaning it was relatively a buy in terms of risk. And then finally in 2016, we passed over that zero mark, and we began to deviate away from what was average, to the positive side, basically, meaning the market began to get overstretched. Since it was kind of a buy here from 08 to 2016, it was understretched, meaning it sold off too hard relative to where the monetary base was, the Fed total assets. Well, the opposite is shown here. From 2016 all the way up until 2019, the Federal Reserve balance sheet was not growing at a pace fast enough to keep up with the stock market. Or we could say the stock market was growing too fast, and the Federal Reserve balance sheet was not growing quick enough to prevent this non-zero reading. Because like I said, you want zero readings. Zero is showing that things are kind of going in lockstep with each other. Things are the norm. That's what you want, a normal, healthy economy. You don't want a bull market that is running way too fast, and it's not keeping pace with, I guess, what would be considered a constraint like the Federal Reserve balance sheet. That, to me, this graph is showing a buildup of downside price risk right here. The moment we went from positive zero to all the way up to this 3 right here, all of that period, which is a good 3 years, all of that period was a buildup of risk in the economy, in my opinion. According to this model, it's showing, although GDP and M1 and inflation, all that stuff, definitely probably supported the S&P 500 price levels. But the issue is the Federal Reserve balance sheet is like a constraint on the economy, meaning there's only so much money in the actual system, the U.S. economic system. Like even GDP would be bound by this variable, I would think, because we are, well, I don't want to say that, actually. I don't want to say that GDP would be bound by this, but the growth of the stock market would be, bound by the growth of the Fed total assets. And so my issue, the whole point of this video that I'm making, is that from the moment I began to learn about coronavirus and it being an issue, because I think I probably heard about it in late 2019, since it was an issue at that time. That's why they call it COVID-19, since it was starting to brew around fourth quarter of 2019, or fourth quarter of 2019. I'm sure it went one ear and out the other at some point watching the financial news. But the issue I have is just knowing that as we reached these levels, basically where we went from let me see here. Look at that. A standard deviation of 2 is here, and a standard deviation of 3 is up here. So as we, I gotta get my laptop charger. As we went from, maybe a normal 1 standard deviation move and went into 2019, we began to cross into black swan territory. in terms of price levels. The S&P 500 has increased. Hold on, I gotta get my charger. Sorry about that again. So as we moved from, we oscillated really, we kind of bounced around it, but as we were, moving from these 1 standard deviation moves or measurements in 2018 here, this is 2018 right here where my mouse pointer is. So as we moved from 2018 to 2019, the peak right here, that's saying that, in my opinion, we were trading, the S&P 500 was trading at black swan price levels relative to the Federal Reserve total assets. When I say black swan, I mean exactly that it's highly unusual to see a black swan. Well, it was highly unusual to see this level of prices, considering the Fed balance sheet had not moved enough to support these levels. I've been comparing it to seeing a leprechaun or a unicorn when I explain this to people. The levels that we were seeing in the S&P 500 in 2019 relative to the Federal Reserve balance sheet was like seeing a leprechaun. If you go back, roughly 10 years and you look at, all this data, what this section of the graph is showing that, like, over the past 10 years in the US stock market and the Federal Reserve balance sheet and its, relationship, we were kind of seeing black swan, seeing a leprechaun type of situation. The price level was abnormally high, meaning there should a mean reversion would be expected. Based on our relationship over this many years, we could say that the chance of a mean reversion is very high, because we wouldn't expect to see us blow through that 3rd standard deviation and go to a 4 or something. Why? Because in theory the stock market again is kind of constrained, in my opinion. I don't know, this is where you train economists and you can educate me there, because I know that there's international money. That doesn't rule out the sources of international money coming into the stock market and bidding it higher. So I know it'd be possible, but since it's the U.S. economy, it's the U.S. stock market, it does make sense to assume that a mean reversion trade would probably be more likely, meaning I just would imagine there's not enough money floating around in the U.S. economy on its own to bid the stock market up even higher. So a mean reversion trade would be expected. The problem there, and this is around 2019, this is the peak of this, is shown as the 1st of September. This is monthly data here. So this peak right here that you're seeing me circle, that data point right there is the measurement for 9/1 of 2019, September 1st of 2019. Okay, so if we're expecting a mean reversion trade here back towards 0, or just not necessarily plummet, a straight down mean reversion trade, but I'm saying if the expectation when we're up here this high, assuming you can't see what's getting ready to happen, I just imagine like this is what things are kind of looking like. I can't get rid of, you get my point though. Imagine we're here. We don't really know what the future holds, but we know that these measurements that we're seeing relative to the Federal Reserve balance sheet indicates that we're up substantially high. and we should expect some kind of mean reversion. Maybe not